All right, thanks, Rich. Yeah, Mark Nelson, Kansas Farm Bureau, Director of Commodities. Um, okay, as always, yeah, good afternoon, everybody. It's always good to be here. I always appreciate the opportunity to come and visit. Had a list there of the things that I kind of want to cover, and as always, we try to take questions. And there was two in particular that I think maybe I can at least take a shot at addressing, and we'll do that. And then I'll turn the other questions that dealt more with maybe where prices are going to go over to Dan. I always defer to him on that. But spoiler alert, first question, what's the best cash price to sell 2025 wheat? I don't know. Second question, what options ownership would you do to replace fall sales of corn and beans? Again, I don't give advice. I don't think either one of us, Dan or myself, give advice. But I think from our comments, you kind of can pull some things out, and we'll try to dive into that a bit. So that first question, let's see here. Hold on, get moving, Mark. Yeah. What's the best cash price sell? And again, kind of tongue in cheek, as high as you can, and hopefully covering your cost of production. But more seriously, we always list out what are the things we can do, post harvest or at harvest and beyond on any crane. And I kind of typically run through these five. Obviously, there's more things that you could be looking at, but you can store it unhedged. You can store it and put a hedge on. And on that storage, you can be commercially at the elevator or on farm. You can sell that crop at harvest, and I think a lot of folks do that, to be honest. You can do a minimum price contract and a call option spread, and we'll look at all those things. But I kind of want to zoom in real quick, and this is sort of a new slide for me. But what this does is it kind of I'm trying to maybe start looking at and tracking where we would be at if we had sold at harvest versus commercial storage versus storing it on the farm. Okay. And again, the one thing that comes out on this is that and I've got 6 locations across the state. And as you look at that chart, man, prices vary. And that's why there's never one answer for any one person, right? Prices vary. But on average, back June 27th, which was the Friday before we talked last June. And so that's kind of my base. I'm kind of saying that's where we made our decision. The average cash six city average was 474 since then. Going back to yesterday, we've lost 14 cents. The six city average was 460. But again, those changes are different. Some places have dropped 20 cents. Some places have only dropped 7. So, the variability in price over the last 30 days has been fairly significant. So now, if you look at these two places that got the stars, first in the blue, the estimated unhedged storage, that basically is where we would stand on unhedged commercial storage. And basically, I'm assuming that we have no storage cost yet because we're kind of using up that 30 days of free storage. And so basically, those unhedged storage returns simply reflect the decrease in cash prices. Further to the right, we've got the on-farm. Those look worse. Why? Well, because my assumptions are, we're going to have a 5 cent in and out charge and we're going to have 1% shrink. And if you make that decision to put it on the farm, you've already committed to those costs. Now, the third thing I've got there I want to point out is this bottom star, 11 cents. If you would have hedged, meaning you would have sold March futures, say, could have been any month, but I was always using March. It would have been 572. If you buy that back yesterday, right? Mark to market there, you would have made 12 cents. Less a penny for hedge costs, you've got a net gain of 11 cents. And so technically, what you could do then is add that futures hedge plus the unhedged storage returns, either column, to then that original price from June. So for example, if you were to say, I'm storing it in the elevator at Colby, I'm down 10 cents, right? Because prices have fallen. If I would have hedged, I can add 11 cents. So technically, I'm up a penny if I got out yesterday. Okay. That's how you'd use it. If I have it on the farm, I'd be down 19 minus 11. That's 8 cents negative, plus the 459. So I'd be at 451 for a net price. So again, prices have fallen. Hanging on to that crop doesn't look real good so far. And again, now, really, a lot of these options, a lot of these alternatives are playing a bit more of a long game, right? We want to hang on to this crop a little bit longer. 30 days is not the window we want to be making these decisions on. So when we look at this, what's the best cash price? Again, back in June, right? June 30th, I looked back at that one Friday prior to it. So June 27th, that's where the market was. And this is sort of a central Kansas example. The cash price was 472. March futures were 478 and a half. And I looked at various things, A, sell the grain. B, sell the grain and buy a call option. C, sell the grain, buy a call and sell a call. And then D, sell a call, buy two calls. So sell a grain and buy two calls, or buy a call and then sell two calls. Again, putting in some collars there basically, and then storing. And my example there is on farm. Again, at that time, as we talked about it, June 30th, really that call spread, C, to me didn't look bad. Taking a look at, selling that crop, just get it out of there. Don't pay any storage and buy the 580 call and sell a 660 call to lower my costs. And what that did was it gave me a little bit higher premium, but it does give me a lot of opportunity if prices would take off. And so now every month we do this, I'm going to kind of show this thing. And basically what this shows is that if I sold the grain, I'd have been at 472, sell the grain and buy a call. And if I would liquidate that as of yesterday, I'd be at 462. So really all these other options or all these other alternatives are down versus just selling it. And again, it's a bit early yet, right? We could very well see a bit of a rally and some of those puts and the calls start making a little bit of money. So I think it's a little bit early to say that selling the grain at harvest was the best thing to do. But so far, given the fact that prices have fallen, the best thing you could have done was got rid of it. But again, I continue to be that fan of that original C, sell the grain, buy a call and sell a call. Okay. Second question was, what options ownership would you do to replace fall sales of corn and soybeans? And the way I'm interpreting that is that, hey, maybe I haven't done much, or I've done a little bit of pricing, but not too much, and I don't want to just rely on harvest sales. Is there something I can do? And so we'll take a look at that. But really, again, it's going to come down to everybody having a different situation, right? Prices vary all over the state, and everybody's in a different, cost situation, right? But the first question we need to answer is, can I cover my cost of production, right? And again, that's what I've been using here, this table for corn. And it's sort of that amalgamation. I don't have the verbiage in there, but these are the same ones we've been using. What we use as farm management guides. We tried to weight them. So it's irrigated, it's dry land, all thrown together, weighted by where we believe the relative to production is. So again, the attempt was to create sort of this is probably the average for the state of Kansas, which means it's not technically right for any one individual. But the key is, can I cover? The other thing I want to point out here is that we have direct costs, which is basically those variable costs. But then the next one, that 354, that's direct cost with cash rent. Because for a lot of producers, if you're paying cash rent, that's really a variable cost of production and you got to cover it. And you'll see then going from 354 or 274 to 354, that cash rent can be pretty significant that we need to cover just to make things cash flow. And then we've got direct with the cash rent and family, and then we've got total cost of production. So we got a range of costs that we might be trying to cover. The other thing we need to look at and just consider here is how much of our new crop production have we already priced, right? Because I think that weighs into your decision making. For example, in our week, winning the game sample plan, we're currently 30% priced at 466 futures, which, given historical basis, would say a 456 cash price. Now, again, a lot of parts of the state, we may be seeing potential for better corn yields. And so maybe that 30% is now maybe only 25% of expected production. So again, that's something else that needs to come into play. Let's take a quick look at what forward cash contract bids are currently across the state. Again, December corn futures yesterday closed at $4.11. And then again, and right underneath that, I've just got a whole column of 6 locations across the state, went to their websites, checked prices. Okay. Everybody's got a different price. And you'll see again, prices vary like crazy. So everybody's got a different situation. But the six location average was 379 for a forward cash contract. Now I threw in there a futures target of, 435, meaning what if I waited to see if we can get futures back up to 435 versus that 411 that we're at now? If we could do that, those relative forward contracts would look like that, more of a six location average of 403. I want to point out that that average forward cash contract bid of 379, that covers direct costs and cash rent, but it doesn't cover any family living. The futures price target at 435 would cover direct costs, cash rent, and your family living expense. So, can I wait? Can I not? What kind of, what am I trying to do here? Because if you haven't done any pricing, you may want to move quickly. But if you've already got a fair amount of the crop priced, you might be a little bit more patient. The last thing I want to point out is, again, and I'm using the 5-year average new crop basis for all those locations. What I'm seeing, and again, everyone's situation can be different. I'm seeing new crop basis bids that are 32% or 32 cents per bushel weaker than average, which isn't very good. I'd like to see them a little bit stronger than that, but maybe that's how we're going to be. But I do have a question. And that question is this: is it time to assume that we're going to see a weak basis this year? Because typically, I kind of run some of these examples and I'll use that 5-year average thinking that, okay, over time we'll get back up to that. Maybe we won't. This is a chart for one location, more of a south central location. But basically, the thing I want to point out here is that, yes, basis changes throughout the year, but clearly, sometimes there are years where basis is stronger and there are years where basis is weaker, and it kind of sticks, right? It takes a lot to change it, right? Because we've got to change that whole dynamic of overall supply and demand. And so I wonder if this is going to be one of those years where, man, we're probably not going to see the 5-year average, and especially in this location. If you look at this here, the last 5-year average, if you run that on Ag Manager and say, give me the 5-year average for this location, it would say that on October 15th, the average is 8 cents over. And boy, you can see that on that chart. But those were the 5 best years out of the last 10. If you take 2015 to 2019, this location had a negative 45.5 cent basis on October 15th. And so again, I guess I'm thinking maybe this is we need to start plugging in when we look at some of these other alternatives, selling futures, etc. Don't use the 5-year average. We may need to be kind of moving that estimate of looking at a weaker harvest or harvest basis this year, and that impacts the financials of how these things look. So let's take a look at that. Again, I've shared this many times, but in the gray area, I've got what I call fixed price alternatives, things that lock that in, right? Forward cash contract. Again, this is sort of a central Kansas corn example. Forward cash contract was 375. And now I'm using that weaker basis, right? Not the 5-year average. I'm using a weaker estimate. If we'd sell futures as a hedge and assume a weaker basis, we'd be at 374. So again, basically identical, except they're 1 cent cost. The other two in green, they're in the middle, buy a put and forward contract and buy a call. Both those are things that help us set a price, but allow us then to have some upside potential. The trouble is those prices are lower. Now, I do want to point out that on that buy a put, in this example, and somebody suggested in our Q&A, I think last month, say, hey, what about that? So, let's take a look at that. I'm buying up. I'm buying a more in the money option, right? Futures closed yesterday at 411. So, really a 410 would have been an at the money option. I'm buying up. I'm saying, let's take a look at a 435. Now it costs a lot more, 31 cents, $1,560 for each 5,000 bushel contract. So it's pretty doggone pricey. But it did move my minimum price up there that, we're within 8 cents of the forward cash contract now. So I do want to point that out. The other one over here is also selling calls raises your minimum price. Now, again, those 4 columns that are starred, those are all options or things that would have use options. So really, these are all in play. And again, I don't give advice, but in many, many ways, buying the 435 put, so maybe buying an in the money put and selling it out of the money call, say the 450, to help lower the cost of that put. Still pretty pricey, but I've raised now my minimum to about where a forward contract is, and I have the opportunity, if we see a rally, to bump up that maximum. Now, again, it's capped. So once futures go above 450, I'm going to be stuck at 386. And again, this is all using that 36-cent basis, which is a weaker basis. And so I think that's fairly realistic. So, maybe that option collar, if I was going to use options, that might be the tool I would look at pretty hard. But before we jump out and do that today, I do want to talk about timing, right? And this is sort of I call it analog years. Basically, these are unfortunately the 6 years that over the last 15 that we saw when the maximum futures price pre-harvest, so between January and roughly, October, late October, the maximum price, the best futures got was 35 cents over the January. Okay, that's how I'm defining that. And so you'll see on some of those, you see that January 1st price, and yeah, it did pop above it very, very short amount of time, right? Excuse me. But again, all these years, prices generally were flat to lower. But the thing I want to point out here is that, typically, you have all that uncertainty that kind of holds futures higher. But once the crop is relatively known, right? After July-ish, maybe, I'd argue we start seeing these things kind of go flat. And so, I wonder if that's very much the thing we're going to see this year. A situation where, okay, yeah, well, we've been downtrending, right, since January. I'll show a chart of that here in a second. Definitely we've been in a downtrend, but are we in line now to maybe, okay, some late concerns? We've built in enough negativeness to this market that maybe we're going to kind of move sideways. Okay. Here then, I plotted this year. Boy, it's tracking right in there, right, pretty close to the average. So again, we're kind of seeing that flat to lower price pattern this year too. Now, I do want to point out that blue line, that's 2020, and right about August, that thing bottomed, and then it started really trending up. It actually went up what 50, 60 cents. And again, I just want to point out. It says $550, $600. Those are cents per bushel. So basically, the 600 is $6, the 500 is $5, the 400 is $4. But again, the point is, in 2020, we really saw that thing rally. But the thing that did that was caused by a confluence of global factors, basically, right? We saw some supply constraints from 15% smaller crop in Brazil year to year back then. And we also saw some disruptions because of the war with Ukraine's exports. And then also we saw increased demand from China because they had that African swine fever. They were starting to rebuild their dairy herd or their swine herds, and so they had more demand for corn. And so we did see a pretty good rally that year after trending lower most of the year. So I'd say that was kind of an outlier, right? That's probably an outlier. But if we did see those kind of factors come into play between now and then, yeah, we could see a good rally. But if we don't, I would expect to see prices flatter. And again, here's that chart. We've been in a downtrending market since February, I guess. Really, we kind of topped that thing out. December futures there in that 475, just about to 480, and we've been downtrending ever since. But if we believe that from now on we're going to go sideways, maybe there's an argument that that 407 and a quarter support is going to hold. Now we dropped it down, 411 yesterday. We were trading a little bit lower. I think about when I last looked today, up a few cents. So maybe we're going to be moving sideways. That would suggest that, maybe this is the upper end of the new channel, 440 to 425. And that's why I was using 435 as maybe a target. So again, when we get in that decision, if we believe the market's going to move in a sideways pattern, maybe if I'm not in a big hurry, we want to let go here for a little bit and see if we would pop, something might pop this up. Concerns that, hey, harvest could be a problem. Who knows what? Concerns about trade. Maybe we pop this thing up 25, 30 cents. And at that point, implement some of these marketing alternatives that we just ran through. And then on the bean side, we're very similar, right? Again, here's new crop bids. And again, very similar to corn. The average forward contract bid for those 6 locations, again, it varies all over the place. Basically, the forward cash contract bid is covering direct costs and cash rent. The futures price, I'm using 1055 as a target, covers direct cost, cash rent, and my family living. Just like corn, right now it's tough to find anything that would cover my total cost of production. The other thing I want to point out, though, is new crop basis bids. Again, with this analysis, everyone needs to look at their own, are slightly weaker than average, but only a nickel, which you kind of would expect that. So these are really pretty solid new crop bids given the 5-year average crop basis. Okay. Unlike what we saw in corn. So here's that central Kansas soybean example. Futures yesterday closed at 10.10. The new crop forward cash contract was 9.41. And I'm using here 56 cents, a negative 56-cent basis, not where we are. So kind of assuming maybe we'll see a little bit of a strengthening in basis. If you don't believe we are, then you may want to weaken some of those estimates by that much. But so I'm using a 56-cent negative basis. Again, let's see here. If we think about options, these are those things that would be, option related. Again, my example here, futures were at 10.10, and at the money put there in that first star would be a 10.10, right? I'm buying up. I'm buying more in the money. Yes, it's more costly. $2,000 for a 5,000 bushel contract, 40 cents. Very pricey. But it provides a minimum 8 cents less than the forward contract and unlimited upside if futures would rally. And I think that's the key, right? If we believe that futures are going to rally quite a bit, boy, you want to keep, you want to give yourself that flexibility. Let's see here. The other thing is also selling calls raises your minimum. So again, buy a put, buy the 1030 and maybe sell at 1080 for 8 cents. Lowers it a bit. Maybe do 11 cents or $11. I'd get 6 cents. That would reduce it at 40 cents. Again, but that puts a cap. But a cap at a fairly high rate, a fairly high level. Futures would have to go above 1080 or $11 for those to not work. And I don't know if that's in the cards this year, right, for this crop. So to me, those aren't too bad of options or too bad of alternatives to think about. But again, this is not advice, but these don't look too terrible to me. Same kind of chart. Yours was flat to lower prices. Again, my definition of that is when the pre-harvest maximum futures price only got up to 50 cents or even less than the January, right? We didn't see a massive rally after January 1 is basically what we're looking at here. And we've got, 4 years in recent history. And I've also got this year in there too. But again, you kind of see that very flat action. Again, obviously we see a lot more volatility with options than we would say corn. But again, we are seeing this year where prices are relatively flat to moving slower or lower. Here's the most recent, as of yesterday, November soybean chart. We closed at 1009 and a half. And if we would suggest that, okay, we're going to start moving sideways, right, from now on, then maybe $10 is that level of support. I think we were popping that down a little bit again, but I think we're hanging in there. Hopefully that $10 will hold. And again, that would kind of suggest that this 1070 to 1040 might be areas that if I have patience, right? Because currently in our winning the game marketing plan, we're already 30% price. So maybe I can be a little bit more patient, wait a bit, and see if we can get up to 1050, 1055. And at that point, again, run the math and look at some of these alternatives that might work for us. Last thing I'm going to look at here is 2026 wheat. Now, typically we say, hey, I say, we start that plan October 1. Obviously, a lot of people start that earlier. I do want to point out, though, with an informal wheat marketing plan, I say October 1. Our big question we've got is what are July 2026 hard winter wheat futures going to be trading at? Yesterday they closed at 584 and a quarter, which is roughly 40 cents, 45 cents a bushel less than last year's 629 and three-fourths price at that point in time. And also note that that has some pretty serious implications for your crop insurance, right? It's going to give us a lower revenue guarantee. 45-cent lower price on a 50-cent bushel yield, right? APH yield, that's $22.50 less revenue guarantee that we would have had last year. Also, I'm kind of throwing in a higher tentative. I'm kind of waiting for K-State to kick out their budgets for 2026, but I kind of increased it 3% just because we're seeing, nitrogen costs kind of creeping up. They're roughly 10 cent or 10% higher than a year ago, but potash and diethylene are both down a bit. But anyway, I kind of increased my costs. But it's important to do a couple of things here. One, start taking a look. What are my estimated costs for 2026 wheat? What am I going to need per bushel? And also, what kind of price protection am I going to have? With that, I'm going to turn this thing over to Dan. Again, I always appreciate everybody. I appreciate the opportunity to be here. So thanks so much.
And Mark, while Dan's doing that, there was a question there in the chat. What about the KC wheat KC wheat September to December carry being at 20 cents?
Well, clearly we're seeing lower basis, and that's real. That's in relation to all that. So, obviously, what does that say? That suggests that again, taking a look at some storage may work. I sure want to be putting on a hedge if that was the case. And again, and I guess I didn't even look at it today, but I'd be looking at something that would let me go, say, into the new year if I'm looking at putting on some kind of and again, I'm assuming we're storing the grain and we're looking at this carry to see if it'll work. We've had good carry, but basis is so weak. And I think it makes storage risky. But again, 20 cents, man. But I want to look at what it is March. Again, that's going to be pretty significant too. Don't know if that perfectly answers it, but maybe that helps to start.
And Mark, before we go on, if there it's I guess striking from years past. We used to talk. We used to say, well, gosh, yes, you could go long and sell and buy the futures. Of course, we do not recommend that just because of the financial risk of finding oneself taking margin calls and having basically having other financial operators, people in the futures market involved in your finances. You take on a lot of risk that way. So we don't recommend that. However, so since we don't want to go that way, we look at when we hold in a speculative position, we hold in the cash market, and really that's if you trusted the basis to not change from where you're at, if there's no change there, then they'd be the same. You're specking in the cash market, but nobody's sending you margin calls. However, I guess that your sort of margin calls is that you could have a really poor price, and it hurt you financially. But so if they there are again, we don't talk about them as much now, but again, hedge to arrive type contracts, basically futures only with an elevator, and where you'd wait for basis to get better. There's not surety given what we know right now. We're seeing pretty weak basis levels, but so, and we are in the time frame where we're paying attention to production issues almost exclusively. We've got some supply demand, some balance sheet issues that eventually will, once the market turns its attention over to the whole balance sheet, not just the supply side, but the usage side too. We've got then we'll be looking at factors that would indicate, well, gosh, we've got higher ethanol usage here or lower. Exports seem to be doing well, or a biofuel, renewable diesel usage on the oilseed side could come into play. Interesting. Just wanted to add that in. Any quick comments before I go on that?
The only thing I'd say is, yeah, again, the carry is always great, but that kind of means that we are storing it. And to your point, Dan, we're assuming that we are going to see some basis appreciation. That's how, the carry in the market works for us. Um, I'm concerned that we may not, but again, I look forward to the outlook. But again, that carry is great, but it's only good if I've got that cash commodity and I'm trying to, trying to gain on that. And again, to your point, basis is very weak. And do we believe it's going to? Now, on slide number 3 of mine, boy, hey, yeah. I'm using the 5-year average basis there, and it's saying, hey, storage works, right? It shows that there's some potential for it. But again, it's all predicated on the fact that we'll see a narrowing in that basis.
And what we've seen in the wheat market has with the carries that we have had, although I think that's weakened just by a penny or two. Of course, we've had wheat harvest, but we had we were looking at 7, 8, 9 cents. I think we're still looking at pretty good carries. Let's see. Well, as of Friday, for the wheat contract, we had got that right. We had 6, 7 cents, and that's down a little bit. But healthy carries play more into the long-term storage, probably commercial storage, elevators, etc. Where they've got quantities of bushels. They're able to manage their transportation costs. In fact, for them making money on transportation probably as much as on the other side, getting good deals there. So most of the time farmers haven't taken the storage hedge route, but what we're seeing in the wheat market probably plays more plays more into the hand in terms of profitability for grain elevators, I would think. Anyway, and one other thing to keep in mind. So boy, we're doing all of this and we haven't and the first USDA crop report that actually will come out and give a hard number other than just an early trend line yield will be this August report. And that's all coming out August the 12th. And they're sending out surveys to farmers and asking them what they think their yields are. Given moisture around, et cetera, I would guess that August report number, unless I'm really surprised, would be probably pretty optimistic, maybe even higher than the 181. But once we get closer to September, then the USDA goes out into the field and actually has their enumerated surveys along with the farmer surveys, and then by the time we get to September 12th, October 9th, November 10th, December 9th, well, yeah, excuse me, through November 10th numbers or crop production reports and WASDE reports with them, then you'll see actual in the field measurements. Of course, harvest will be here, and if there are gaps out there in the U.S., they're more likely to show up. I don't know that in the August report, given we're still somewhat speculative, and the overall narrative is for big yields, that we'll actually see any change there. Just on a side note, learned something this past week that we generally wait for the big January report to come out as kind of the final truth teller, but they actually do that. Well, I guess if our NAS colleague is on here, it can verify this or not. But I think they continue to. I think they still do a measurement on December 1st. They just don't release that until the January report. So they don't. I don't know that they do a yield survey on January the 1st. Who would answer it from NAS? But so anyway, most of the things, any information that's considered hard information or nearly so coming out of the USDA is some of that will come here in August, but it's going to be September, October, November, and then January, to where we really would have anything other than this narrative that we've got right now for large crops. And I'm not saying that narrative is wrong, but that's how the information will flow. In terms of just quickly for weather, predicted soil moisture from now through August 6th, really no. There's some dryness in parts of Illinois, Indiana, Michigan, some up in the north and the Dakotas, but most other areas really doing pretty good. Most of the other major production areas that we're looking at, not major threats there. What I have heard from listening to alternative sources, independent sources, is that there are pockets of dryness in parts of Illinois and Indiana in these areas, and some awfully important corn production counties. So I guess I listened to that just to make sure I'm not completely surprised if later on the current projection doesn't work out. And worldwide, this is how, from a satellite view out of NASA, how they view our soil moisture situation. In the U.S., dry to the west, Corn Belt looks awfully good. And you look at parts of Russia, Ukraine, etc. I hear reports that hear and read reports that gosh, things are going to be great. Don't worry about it, no problem. But then I see it's awfully dry there. So I don't know that all that is finally determined. What is hope? What's realism? I don't know. Uh, there have been major problems with wheat in China. You see some very wet areas. You see some pretty dry areas. Did you go to South America? Again, a lot of the Mato Grossos of the world, et cetera, they're off into here. If anything, in some of these areas, we've been more concerned about things being too wet than otherwise. And Africa, some dry areas, and then Australia. So uh, rain makes grain until it doesn't. And so right now it's not dryness that probably would be a threat. It's ongoing rain and how that might affect things. We're pretty much putting the corn crop to bed, not thinking that there'll be anything that's going to be a risk to it. Again, we're through almost the very end of July. It's now August that we're paying attention to. And so uh, we're I don't think I'm not comfortable just christening 15.7 billion bushels of corn and 2.3 or 4 or 5 of soybeans without acknowledging that, hey, we're not there yet, and we really haven't had close surveys of what's out there, and we won't have that for another 45 days or so. So, um, looking just quickly, feed grain markets. Mark, I want to hit my high points and add and supplement what you talked about. Corn futures, I see those carries. And I also have included what's happened from the when on the May contract when it went off the board to the July contract, which just went out, and where we're at with the September futures. And if you look back over the last X number of years, 10 years or so, it's not uncommon to have market lows in September. And the market pays attention to production prospects and and uh, uh, and then really doesn't turn its attention to the demand side that much until we get past September. What happens in September? The first survey-based measure with both farmers and the USDA out in the field. So that we'd be lower to now would be fine. And to your point, I can't dispute that, things tend to look pretty sideways, other than once we are convinced, we being the collective market, that we've got a large crop, then we start turning our attention to the demand side. Again, export buyers, ethanol usage, et cetera, all in play. Still contend that when you look at the projected corn balance sheet for this current marketing year, we're at 1.34 billion bushels according to the July report, and that's when we've been down that low before. We've had pretty explosive prices, but it's the new crop coming on that the market's paying attention to. But even with that, we're projecting strong usage. So with 50.7 billion bushels, we're still looking at 1.6, 1.7 billion bushel projected carryout, which is, that's not 2.5 billion. That's closer to 1.5. So if anything, the market's singularly focused on the supply side, and the usage issues are lower priority right now. So, Mark, that comes into that would play into your discussion of what's likely to happen with stored grain thereafter. Any comments on that?
Not a whole lot beyond, I think the market's got, to your point, yeah, we're really focused on the supply side, but I think they're also thinking there's just nothing in the pipeline that says things are going to be a problem. Obviously, every time you start thinking that for very long, things do change, right? So there could be a problem, and obviously that would change things. But yeah, the momentum is sideways,
So
and it's
so
going
the
to take a significant change, right? We're going to have to see a bigger jump in exports. Uh, and again, with some of these trade deals, hey, we could get it next week, tomorrow. But at this point, the market's not really looking at it. And, like I say, are we going to see a black swan that surprised the market? I think that's sort of
well,
it, isn't it?
and the market out of necessity is pretty myopic. It's hard to forecast out there, but again, if we don't have 3 billion, 2.5 to 3 billion bushels carry out projected, we're projecting really moderate to fairly tight carry out, but we're not focusing on it yet. And just quickly, you can see that. So for corn on the markets, we had gotten down to 385 latter part. Well, and let's see, this is what that was. That's December. Then that's January, December, November, October, September, August. we were down to 385 last summer, and then came up thereafter. So a person could sit there and count through these months as to when the lows came and when did the markets respond. And so I don't think I think there's still uncertainty out there, but boy, the market has its focus right now, and you can see that in the net corn futures position of traders. This red is the managed money specs. This is in terms of bushels. So this is like 2 billion bushels long, 2 billion bushels short, and you can see the net traders position has turned negative without question, and that's reflected in what's happened in the price trends as you showed on your charts earlier. And when you just look at the managed money specs, how it breaks out, they're about 1.9 billion to the sell side. Again, short positions and about just under a billion long. So there's a balanced in view, right? Balance. Well, it's an unbalanced view where the short positions are almost getting near 2 to 1 of the longs. But so you can see this type of a movement is what you'd expect with a bearish market. Note back in 2024, we got down to that 385, 2.5 billion long. So we're not quite there yet, but unless the demand, if demand would weaken in light of and combined with a large crop, then these 2.6, 2.5 billion bushel short positions are, well, we'd see ourselves in those neighborhoods. And for futures, it's always interesting to look at what the futures are projecting versus what the USDA is projecting. USDA's forecast for the next marketing year, 25-26 marketing year, that which begins September 1, $4.20. Right now, $4.40 is this black line. By the time you weight the monthly prices of futures minus the basis assumption, or adjusted by a basis assumption, about 440. But note what's happened here on this marketing year in the red. As we go through these months, May, June, July, August, and that August is a projected number, of course. So really tailing off here in the summer, and the average of what the market has done in Kansas anyway has tended to be like that, although we're on a percentage basis, we're even more than average to the downside as a move. I've been watching ethanol plants. Even though ethanol demand holding up decently, production doing okay. It wasn't, but well, note this price here. A year ago, the corn price at Kansas ethanol plants is $4.47 on this date, and that was the strongest price by far any place in the United States in terms of a state average. This year we're at 380, and we're if anything, we're in the lower half of what's going on in the strongest places for bids. Actually, Indiana, Michigan, Ohio, and that I guess you call it the Northeastern Corn Belt. So we're not anticipating any shortfalls in Kansas right now on ethanol, and it's being reflected in the ethanol plant prices. 15.7 billion bushels. That has the attention of the market, and I put, you have to think that it's that 50% probability that we'll see that, given the moisture we have, unless there's some major surprise, et cetera. But that the likelihood of that occurring seems to be at least a coin flip. There are some things that could make it weaker, but we'll see. I've got a whole bunch of slides here that I don't have time to take and show you, but you can see the usage figures. So far, no weakness really showing up. Feed usage, 5.85 billion, almost record. 5.9 happened not that long ago. Ethanol usage trending up generally, holding steady. Exports on the high side, not the very highest. That was back in 2020-21 at the 2.75 billion, 2.675, awfully strong. Ending stocks, 1.6 billion. So we're projecting when we were back in this 1.36, 1.235 area, 2020, 21, 20, 22, 23, we had pretty strong prices. We're down here now, but back in that area, but the market has its attention on 15.7, 50.8 billion bushels. Strong exports. The best cure for low prices is low prices, and we're a relatively good buy in the export market. That plus a weaker U.S. currency in international trade circles, giving us almost as strong a corn export pace as we've seen historically. You can see for where we're at right now, that purple's the 24-25 marketing year, it's old crop year, and that's tied for 2021 for the strongest we've ever been, tangibly stronger than last year. And again, ethanol doing pretty well. So here's where stocks to use are: 1.6 billion bushels, 1.66 projected for the next year, 1.34 for this year. With that, projected stocks to use about 10.8 billion, 10.8%. And you can see where that compares historically. Now let's see if what I said was right about those years where we were tight. Yeah. When we were down in some of these areas before, you had tighter stocks to use below 10%, pretty strong prices. We're again this year we're kind of straddling the supply demand prospects for this old crop marketing year with the intent or understanding of the new crop coming strong and prices at 420, which would be the lowest since back in 2019-20, and without question, that's where the odds are right now. If that doesn't happen, basically, this is an effort to hold out and to acknowledge that 181 might happen, but it's either too dry in some of those key areas in the Eastern Corn Belt, too wet. Maybe things, once we get in the field, we don't know exactly what's going on. I do hear rumors of tight corn wrappings occurring, but again, right now that's just rumors. So 50% chance, pretty strong. 45% chance, well, maybe not 181, still 179, still a record, or right near a record. Either way, you're still hanging around. So 95% chance of 420, 460, something like that. Still a 5% chance of whatever, and that's probably too wet harvest. Something along those lines that would slow us down. But everything we're looking at looks to be awfully strong production, either 15.7, 15.5, and stocks to use hanging around 10 and 420, 460. There we go. There's some international issues to look at. I would say when you look at world stocks to use, world versus world minus China, again, we're not just awash in corn. So this year we've got enough. We'll come into next year, into the spring. Any threats in South America or whatever, probably going to be a pretty volatile market in terms of being reactive to whatever happens, because in both the U.S. and the world, we just don't have lots of grain. But I guess the psychological response right now in the markets is that, hey, we got enough now. We'll worry about tomorrow. And so we're not really focused on building up stocks. I think they call that just-in-time inventory, which is great as long as it keeps coming just in time. Okay, would say that Mexico, strong U.S. corn buyer, the number one right now, and you can see they're importing pretty seriously in terms of their. You look at that blue line, 24.8% of 24.8 million metric tons of imports. That matches their production, their usage 49.5. So they need corn, and here's our, I wouldn't say nemesis. I'd say they're just profit maximizing, but they're sure our competitor in terms of Brazil corn supply demand, and they're harvesting. What they've harvested this year is in the 24-25 marketing year. What they're projecting next year is in the 25-26. Note the thing that's happening for them. They are through ethanol usage, other they have the same categories we're dealing with. They're using more grain domestically. That's something for us to watch going forward. But I guess the point is, so are we. So we'll see what's left in both these countries down the road as we keep going on for actual exports. And I did want to show you some for grain sorghum. Prices aren't very, very strong for grain sorghum prices. But if anything, what's more optimistic would be you look at Hutchinson, the current cash price, 333, the forward contract bids 374, and you have to look twice and make sure you're looking at the right thing. So you've got Mark, we're not talking a lot about forward contracting for sales, but if we don't see any change and the current low prices just roll into harvest, we could look back at something like 374 as a lost opportunity. Comments, thoughts?
Totally agree.
Yeah, it's not everywhere, and you have to be within truck driving distance to take advantage of that. But you look at these differentials. New crop bid for grain sorghum almost 350 in Topeka, Garden City area, and I think that's 36 cents above the current cash price. So if you're there's some aspect of protection with forward contracting grain sorghum going into the future if that's where you're at. Okay, 5 minutes. Here we go. So not a lot of carry in the futures, but again, let's say they're not a lot on a monthly basis. 8, 10, 9, 8 cents. So again, to do a storage hedge, you're gaining from if November stayed at 210 at 1010 and March was 1044, that's 34 cents. And you have to divide that out by the number of months you're dealing with and your costs involved. Soybeans about $10. I'd heard Scott Geralt at we just had a meeting of the ag economists in the U.S. here in Denver, talking about his concerns about the soybean market. He was thinking that the current situation, holding us up at about 10, he felt was he saw underlying weakness in that. Now, as soon as we say that, we'll probably have a tremendous rally in soybeans. But it was interesting to hear him discuss what he thought he was seeing in the oilseed market. And I'm surely not against, in fact, enthusiastic about what's happening in the oilseed market for biofuels. But boy, the point that came out with that, by the time you get a bunch of economists in there, a lot of discussion about how dependent the oilseed usage aspect of crush is and biofuels on subsidies. And if that ever weakened, that would, where would that stand without subsidies? Not very well. So I'm not working against that at all, but just to note, there's a political support issue involved on the soybean side when you're looking at crush. And soybean futures, if anything, of late here, a little bit of longish side in terms of the net position of futures for managed money specs. a little bit positive, and you can see it in that just slightly positive, more of a balanced long versus short viewpoint on soybean futures as well. So interesting to look at. Futures projecting soybeans about 10.18, and USDA's projection for next marketing year is 10.10. So not a lot of change there. Projecting 4.3 billion bushels. So-so exports, you see we're kind of in the middle for 2024-25 as we come to the end of this old crop marketing year. We've had better years, we've had worse years. We're just sort of in the middle. Note, you really see that the growth we're seeing in biofuels usage. EPA came out and did give their support to renewable diesel, biodiesel production within the last month. Very much well, what you see here for the USDA's projection, very much relying on that support going forward, very much. And you see a general downtrend with these blue lines on the export side. So it is as it is. Stocks to use for beans, 7.1%. Projected for the next coming marketing year, 310 million bushels, about 45% likelihood by Dan O'Brien's judgment that that's going to come in. And the only reason that's 45 and not 50 is that I think I've always read we make soybeans in August, and we're not there yet. So I'd like to see what August does before we'd say it's just give it a 50% in judgment. And with so these. Again, you can see what the USDA's projections are, basically around $10, about 7-8% stocks to use for all overall US. And it's hard to not just acknowledge that right now we're looking pretty good for beans. We do need to get through some really critical reproductive periods. 45% chance likelihood seems like the USDA is right. Another 45% chance, a coin flip there that things won't be just perfect for beans. So that's 51 bushels an acre yield, and then 10% chance of things happening worse than we're realizing right now. So, but with that, $10.10, take 1.5 bushels off of that, plug that into the supply demand balance sheet. You're having to start to ration already just with that. So already you're down to 7% stocks to use. For this not to drop below 100, to get ending stocks that would be below 200 million bushels, you've got to start rationing. So for beans, more so than corn, you can't afford to have a shortfall of what the USDA's projection is, or you're going to have to start raising prices to the degree that you're changing the usage in that balance sheet. So there's projections, again, somewhere between this and this, but really kind of a tightrope, more so for beans than for corn. Okay, I want to move to wheat. Again, if there's anything that's probably a collective downer for Kansas commodities, it's that we're right in the middle of wheat harvest and prices aren't very good. And you can see where we have been over the last several years. We're hanging around the lowest of where we've been. We've just come off about a month ago, just still stayed above $5, but just barely. And now, so we're about 5.22 here. And I think I looked today, I believe we were down just a few cents. So hanging around there. And you see the net position of traders, they're reflecting that, showing 300. Well, this is for hard red winter wheat only. That would be basically, we just came through just about a recent, since 2006, record net bearish position of traders, position for managed money specs. And this 574 almost was when you look at only the long versus a short position. So bearish in the wheat market. All that said, we've had some great exports of late. cheap prices have really helped us. USDA's projection 540. The market's thinking just about the same, 542. And for all wheat exports, in the U.S., ups and downs, but really for hard red, the last several weeks we've had a pretty strong positive trend for hard red winter wheat exports. I've got on the side, I figure we look at the actual shipments plus forward purchases. I think we're over 40% forward purchases with only about 6 weeks into the market here, about 13-14% of the way through. So we're pretty strongly bought ahead. And I'm not sure, haven't, I guess, filtered out whether, is that from Russian problems, or is that Ukraine issues, or just where? I think it's a combination of pretty cheap harvest prices, available supply, and oh yeah, the U.S. dollar is pretty cheap too. So you can see exports. USDA raised their projection in the July report up to 850 million by 25 million bushels. So we're when you look at overall percent, pardon me, percent stocks to use, been climbing the last bit of time. Price has been falling to about 540. And is that going to come about? Here's the USDA's projection. You can see this 850 million bushel figure. It seems like with what we've got going, that the chances of us falling back on exports are less than them growing. So 850 million bushels, and if we're either down 25 or up 75, makes a fair difference. Right now, projecting to 540, we start generating another 75 million bushels of purchases, then that gets us looks like the $6 or above. So Mark, if we hold wheat, I guess you can, the next time we get together, you can say, well, O'Brien, your caution that hey, the wheat market exports actually are tangibly affecting the cash market and giving a return to storage have come true or not. But it seems that the odds, if we do see a change from where we're at, the odds are that exports probably going to help us, because it doesn't look like the U.S. dollar is going to strengthen anytime soon. Thoughts on that?
I hope we do see basis strengthening. I hope we do see prices rally. I hope we do see exports rise. When we look at just our typical analysis of returns to unhedged storage, hey, beans, you're in, you're out, works well. Corn, pretty close, but you can make money doing it. Wheat is typically the one that, man, it just historically doesn't. And obviously the reason is because we typically you keep sliding for a while. And so then, for 2 or 3 months, you're just trying to catch up to where you were. Because again, the key here is on a post-harvest, it's what could I have gotten at harvest time, right? What could I have gotten right off the bat?
Yeah.
It's not what can I do this month, like if I'm looking at November versus December, it's not what I could have done then. It's what would I have been if I just would have sold it at harvest? And typically you're really fighting it because the U.S. wheat harvest continues for a long time, and we just keep lowering it. But yeah, anything can change, and I'd love to see it.
And just to finish up, again, this conundrum here, just to watch, world wheat stocks to use sliding down to 11-year low. That's the world numbers. The world less China numbers, 20 point some percent stocks to use, 20.7. And you can see the world, by the time you take China out of that, we still are tightening up. So you would eventually that has a bearing, but the market is hand to mouth right now, and it won't pay attention to that until it just can't get wheat somewhere else. So we have enough countries that grow wheat that need the cash, i.e. Black Sea region, 2 countries having a war involved in geopolitical conflict that need cash, and they get it, they sell it. And so it is as it is. So with that, we're why don't I stop this share here? And for people that are still around, if they have any questions, we can try to address them. Ward, I see your question. How much of the solid Mexican corn demand can be attributed to feeding out the cattle that are not being allowed into the U.S.? Could this lead to Mexico expanding their cattle feeding inventory? Ward, I think you're ahead of me on that. I need to talk to my colleague Glenn Tonser to see what he's seeing on that. But yeah, if those cattle aren't being allowed in, I guess I don't know what reliable feedlot number survey there is for Mexico. Again, their USDA. I don't know they have a close USDA NAS substitute down there, but I don't doubt you're probably right. Um, what I do know is they're our strongest ally. I know there was a big issue with regard to in the last year they were worried about GMO corn going down, coming into Mexico and affecting, in their view, contaminating their domestic human food supply. And there's big kerfuffle over that. I think that was dealt with by the U.S. corn industry. But yeah, there's a demand pull. They were pretty dry until recently down there too. So it'd be probably a issue of corn supply versus carryover corn supply issues versus challenges otherwise. I see a good question from Mike. What are your thoughts on corn prices if yields closer to 185, which you are hearing chatter about? It's weakening. It would weaken corn, bring it lower. It would be a almost complete buyer's market, and then the only thing that would then the main factor that would keep prices from just dropping off would be some aspect of increased usage. If you get to 185, you plug in the numbers, then those ending stocks figures, they're a lot closer to, if not over 2 billion bushels, and then I think we classify that as an oversupply. If that occurs, then the question may not be what this year, but if we're that pessimistic on in terms of the cash prices we're getting, do we keep planting corn? So really, you probably raise a question about what happens in 2026 to corn acres if you see that, just because farmers will respond to low profitability in a more negative manner.
Hey Dan, I throw out a question here to you. In your modeling, I mean, could a person make the argument or the idea that maybe that's part of what's reflected in 411 futures, 414 futures right now? The fact that, again, to Mike's point, I think the market's saying, hey, we could be 885 bushels, and a little bit of that is already built into prices, and so it's
Yeah.
in my mind, then if that comes to fruition, it may be less of a negative because it's kind of already weighing on things. And to your point, the opposite is true. Is that if we start seeing these issues, we don't see as good a fill, and then all of a sudden in later crop reports we start seeing, that okay, no, we're not going to be there. That could be positive to the market. Is that
Well, I think there'll be how can this not be a year when people will try to get ahead of the USDA and go out and do their own field surveys? Any major buyers in the survey to look closely in the field for their own, with their own scouts, to see what's happening in the Three I states and other key areas. Just again, you have rumors of this tight leaf sheath wrap issue going on, et cetera, and you got to be careful about talking about those, because we're not just trying to talk up the market, just trying to identify that there's still uncertainty out here that needs to be dealt with. And I guess the thought on that is that in the algorithm trading quantity, again, numerical figures driven trading environment that we have, there's not as we trade on somebody's estimates of what the numbers are, and I don't know that in our computer driven environment how we account for the intuition of uncertainty yet. I think when we get numbers and we plug it into a model, it goes to 375 corn future, just because, gosh, we plugged in 185 would take us to 16 billion bushels of corn, ending stocks to use climbing 12-15%, and that would without question it'd be negative, but in our algorithm driven environment we go there quicker because I don't think we have that residual caution about the uncertainty of things yet. might mention something that so far I I think on the tariff issues we've seen. I heard a new term about at here within the last few days that they're talking about uh, taco tariff discussions, in that with the idea that the U.S. administration uh, puts a hard number out there and then almost always backs off of it. I think a taco is crunchable. So anyway, so there's and we've seen really pretty reasonable numbers with Japan, with Vietnam come about, some EU here of late. Right now, this week, you've got the biggest issue going on, the discussion with China, and of course that's a soybean market driving factor. So we'll see where that comes out at. But I think again, by far the biggest issue has to do with U.S. and China trade, and not just what's agreed to, but the enforceability of it. That's also just by a track record, that's pretty important.
Well, just to close here, glad to have you on. And Mark and Dan, thanks for doing this. And we'll have this again in about another month. We don't have a date set for that, but I'll send that out when we have it ready to go. So thanks for being on.
Thank you, folks. Thank you, Mark.